Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at the latest with regards to crude prices. We'll do a brief review of the US reporting season so far. We'll also do a preview of the US GDP numbers, and finally we'll have a look at that SA inflation print which came out last week and the MPC meeting the day after. We're going to start off with the latest on crude prices. It appears that there's been a halt in the US-Iran war, and the net result of that is that crude prices are down around about 4% this morning, but bear in mind there's been a recent surge up until that point. Even after accounting for that surge, and this is an important point, the month-to-date average for US gasoline prices is in fact below the monthly average for June last month. So month-on-month has actually been a decline in the average fuel price in the US, and the net result of that is if crude prices remain where they are now and refining margins remain where they are now for the rest of the month, in fact, crude will be a disinflationary force for inflation in the US for July. So unlike the couple of months before, where if crude prices cause a surge in US inflation, the spot prices, even after the recent surge, will actually see a slightly lower US CPI print. And that means that crude prices still, even at spot prices, are taking a bit of pressure off the Fed. I'm going to come back to the Fed. But it's important to note as well that we're seeing a reporting season come through in the US, which is simply extraordinary. Based on the latest consensus forecast, at this point, it's expected that the reported earnings in the US will be up around about 39% year on year. Now, it's important to note that a lot of that growth is due to a once-off or a revaluation of securities that's reported by Alphabet. And if you were to strip that out, then earnings growth is running at about 25% year on year, which is still a very good number. You're looking at, let's say, a normalized approach, 25% growth in the US for earnings. And next quarter is expected to be around 28%. These are very strong numbers, even after stripping out a few once-offs. And it's difficult to be underweight global equities in that sort of environment. In fact, this is why we shifted back to neutral a couple of months ago, is that we saw these earnings numbers coming through. And given the strength of earnings, we expect that that's likely to provide some support for global equities. Fixed income, alternatively, has had a tough time. If you look at the US 10-year bond yield, it's currently at 4.6%. which is quite high by recent standards for the US bond market. And if you have a look across the globe, the US is not alone. Most bond yields of the countries that we track have gone up since the conflict in Iran started. The one exception there is China, and that's because Chinese inflation continues to be low. And in addition, it appears that there's some form of austerity currently underway in China. If you look for the first half of the year, the deficit's actually down around about 13% year on year. So you've had a combination of low inflation and an increasingly austere government, and the net result of that is that Chinese bond yields are slightly down relative to the beginning of the war. Every other country that we track has seen their bond yields go up. And just to put that in context, if you look from 6 years ago through to now, the Treasury index in the US is down around about 7%. It's quite a meaningful decline. I mean, if you think over 6 years, you'd still actually be down after investing in what should be the safe haven asset. And that's before you account for inflation. After accounting for inflation, losses would have been around about 30%. So it's been a terrible period, a 6-year window for US Treasury investors. And if you look at how that yield curve has shifted, it's shifted across the entire yield curve. We've had hikes from the Fed. The yield curve at the short end of the yield curve is up over 370 basis points. And at the same time, we've had these concerns around inflation, which has seen the long end of the yield curve shoot up by around about 400 basis points. And the net result of that is that the US 30-year inflation-linked bond, which would give out payout of inflation plus, is yielding around about 3%. A real yield of 3% is quite high. An expected equity real return would be of somewhere around 4 to 5%, so a bit higher than this. But even so, in the back of our minds, it's a little concerning that the US is having to offer such generous returns to attract long-term investment. And this is a theme we've spoken about before, and we are going to be speaking about quite a bit more over the coming few months. it's important to know it's not just the US. We've seen an increase in bond yields across the globe. We've spoken before about the increase in the Japanese bond yields. European bond yields have gone up. UK bond yields have gone up. US bond yields have gone up. It's just been a bad time for bond investors across the globe, given the inflation shock that we saw post-COVID, and now we're seeing another one come too. Growth is still looking okay. We've got the US GDP number coming out this week. The consensus forecast is that growth will be just a bit above 2%. The Atlanta Fed number is just a bit below that at 1.7%. So these are not bad numbers. And so if we take a step back, we've got an environment where inflation has been quite elevated, and it's not been helpful at all for fixed income. But GDP growth continues to be quite good, and the earnings numbers are exceptional. And in that environment, we're about neutral global equities, but we do have some reservations around the ability for treasuries to provide defense in an environment where inflation is high and the US has some fiscal concerns. And finally, on South Africa, we had the SA CPI print come out last week. It did surprise on the upside, came out at 5%. We do expect that it will come down a little bit for the July reading, but then it's going to drift up again, and we think it'll get to just a bit over 5% by October. Now, the SARB didn't hike last week, but given that inflation is likely to stay at around the 5% level, we think for the near term at least, we think there is another hike on the way, and the market, in fact, is pricing in somewhere between 2 and 3 hikes by March next year. So if that is the case, it clearly would be a headwind for SA Inc. Hopefully the SARB is able to hike by less than that, but a lot hinges on those inflation numbers, which in turn hinge on the oil numbers, and we'll be keeping a close eye on those and providing updates over the coming few months and weeks. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.